Get this. 100,000 profit, ROI 2%, and that's with the most conservative GDV. Hey guys, today we are going to be checking out a property that's sold, and we're going to be looking at it through the eyes of a property investor to see if that property is a good investment. Today we have a crazy opportunity. When I did the figures for these, when I ran them, I had the double check, I had the triple check. I had to use other services to make sure I wasn't going crazy. And from what I can research so far just online, this looks like an incredible deal. Of course, I'd probably have to get more like agent evaluations if I was putting together this as an actual deal in a pack. But let me show you what this deal seems to be making. So the property we're looking at today is Queen Anne Avenue. It's in Bromley. This is a London property. And as you can see, this has got the stuff that I love. It's in awful condition, rubbish condition. Very nice property, very big. It's 3,500 square feet. Huge property. It actually used to be 3 separate flats, and then they converted it back to a big house. And so I assume it could just easily be converted back into 3 flats if that wanted to, if the investor wanted to do something like that. But it's on for 950. Now I don't know what it actually sold for, but we're going to take 950 at face value and say that's what it got paid for, and we're going to use that as at least a baseline. So once you've got yourself a property, a potential opportunity, the next thing you need to do is you need to work out what it's actually worth and also what it's going to be worth as an end value. So this is where things get a bit wild, a bit crazy. I have great comparables. All my comparables are on the same street as this property. They look the same. I have a current market value comparable. So there you go. So inside, unmodernized, needs complete updating, and this sold last year. So I have a great comparable for what it's probably going to be currently worth right now. Okay. Then I got great end value comparables. They look great inside, same street, fantastic, right? So when you're working with comparables, what you need to do is find when it was sold, how much it sold for, and how big the property is. So you can divide how much it sold for by the square footage. That gives you the price per square footage. And then depending on when it sold, you can see how much houses have appreciated or depreciated in that area. And then you're able to adjust the price per square footage based on that percentage. And that will give you a better estimate for what the property is going to be worth. And when I ran this, I was blown away. I had to check. I had to go on other websites. I had to use other computer-generated softwares, and they all kind of give a similar range, right? So what I did is based on that, I was like, okay, well, let's work it out if it was converted back into flats. So I did comparables for flats in the area, and I pretty much got the same answer. So what is the end value for this, apparently? 1.76 million. That is a huge margin to work with, right? If you buy it for 950. And if you did it with flats, I was getting 100,000 less, but that's still 1.67 million, still huge, still within the range of each other, right? Not massive miles off, still pretty close. So I also decided to use some computer generated softwares. When I'm putting together a deal pack, you want to use computer-generated softwares, you want to do your manual comparables, which are the strongest comparables, but then also get 1 or 2 agent evaluations to work with that. Because this is for a video, it's a property that has been sold, I'm not going to get those property, I'm not going to ask agents for the price of this, so we're just going to work off 2 of the 3 options we've got available to us. So once I use the software to predict the price, now these can sometimes be completely off, so that's why it's better to do the manual comparables. This is what I got, 2.17 million. It does say plus or minus 130K, so let's say it was 1.9 million, right? If we take the lowest end of this computer generated, software. And that finds loads of comparables. If you scroll down here, look at all the comparables it's pulled from, right? So it's done that. And then I also did it as a flat, if it was converted into a flat. And we're looking at 590 plus or minus 35K as a flat. So you times that by 3, we're getting like 1.6 million. So we're in the range, right? The softwares agree with me. My manual comparables, which is the strongest way you do comparables, they agree with me. So I went with the lowest comparable GDV that I could, just to try and make it as fair as possible. So now we have the purchase price and the end figure. The last thing to do is work out what the build cost is going to be, right? Normally, when I'm putting together deals to sell, I work with builders that quote up the projects and are in place willing to take them on. So if you buy a deal from me, then there's a builder in place if you choose to use them to streamline the process. However, I'm not going to get this quoted because I'm not going to be selling this particular deal. However, I do have understanding and knowledge on a surface level of all the costs in a property. And without going to the property, this is the best I can do. So new flooring, plastering, repaint, rewire, 3 new kitchens, 3 new bathrooms, boiler. If you take away some of those kitchens and bathrooms and the bedrooms, you're getting an even bigger property. But there's so many things you could do with this. We're not going to get into every exit strategy. But I came up with a cost of $137,000 to get this back up to standard, and that is including a 20% contingency in case things go over, I miss something. It's very safe, 20% contingency, especially as I've not been to the property, right? So let's, now we've got the purchase price, the end value, we know how much it's going to cost. We know the fees, we're going to have to pay, almost 70,000 or 65,000 in stamp duty, legals probably about 4 grand, sourcing fee. So if you bought a deal from me, then you're going to be paying like an agent fee, which is 2% of the property price, and that's almost 20,000. So your total investment is 1.7 million, right? So we know how much we're putting in, and we know how much we might be able to sell it for, right? Get this, 500,000 profit, ROI 42%, and that's with the most conservative GDV. Crazy. So if those numbers work, this person's found an absolute banging deal, and congratulations, like that is crazy, well done. Absolutely amazing value and amazing opportunity there. I would get so excited if I saw something like that, but I'd also be worried to sell a deal like this because it just doesn't seem possible, right? We're looking at a deal, typically when you sell a deal, a great deal is 20% plus on return on investment. Anything above 30 gets suspicious. 42%, yeah, I'd want to do a bit more research on it. But taking it at face value, 42%, wow, what an amazing deal. But let's say you wanted to generate some cash flow from this. You wanted to keep it and then rent it out. If you did it as a buy-to-let, you'd be renting this out for about £6,000 a month. You have to pay maintenance and management fees. You're looking at profiting £55,000 a year. But if you leave all your money in the deal, then that only gives you a return on investment of 4.75%. Now, let's look at it if it could work as a service accommodation and an HMO. I'm going to start with service accommodation because service accommodation is huge in London, right? At one point, service accommodation, I believe, was like 20 or 25% of the entire residential market. Everyone was renting out their homes because they made so much money, to the point that London had to put in regulations and limit the amount of time you could rent your property out on Airbnb or Booking.com to 90 days, right? So there's lots of money to be rented it out as a service accommodation. But if you were to rent it out for a whole year, you'd be looking at the average occupancy for this particular area is 74%. It says 73 now, but it was 74%. Average daily rate is £77, right? And if you were to rent them out room by room, then 8 rooms, you're looking at getting £608 a night at 74% occupancy. If you were to rent it out all year, you could get 105,000. Of course, I know a lot of people do rent it out all year because they have their methods. But if you wanted to keep within the law, maybe you could rent it out for 90 days during the summer, where London makes the most amount of money when it comes to service accommodation. And for the rest of it, you could either rent it out as buy-to-let or even an HMO. Now here's the thing with an HMO. Bromley does have an Article 4 in the area. Now I haven't gone deep into Bromley because into the article areas, because it looks like a lot of individual roads have Article 4 and patches of land. I'm not sure if every area in Bromley is Article 4, so that requires a lot more research. However, what you can do is you can turn it into a HMO, and without changing the use class, you can then rent it to a social housing company, and they will use it as an HMO. And because they're using it as an HMO for social housing, emergency housing, whatever, they get around all the regulations. So, and you might be able to make even more money because they will typically cover the management and the maintenance of the property. So, little tip, if you're thinking about getting the most amount of money out of your property as an HMO, consider renting it to a social housing provider. And if you did it that way, you'd be looking at getting a profit of 74,000, which gives you a return on investment of 6.34%. So that's fantastic, brilliant. Makes lots of money if you did it as a flip. With the buy-to-let, with the HMO and the service accommodation, it's slightly better with the rent. However, this is where it gets crazy. Because you're uplifting the value so much, if you're a property investor, you probably know you sell a property, you have to pay a lot of taxes. However, if you refinance it, you don't. So people refinance and then on to the next project, on to the next project. And the golden opportunities are where you can get all your money out. Now in the South, that doesn't happen very often, right? Because properties are expensive, rents are expensive, and by the time you refinance, the mortgage is more than the rent. So it doesn't really work that well in the South. However, because of this one with that kind of margin, if we go down here to the refinance calculator that I have, if you were to get a mortgage of 75%, right? If you rented it as a buy-to-let, it wouldn't work. The mortgage would just be too much for the rent, right? But as an HMO, in fact, only at 70% for a refinance, you would be able to pull out not just all your money, but a further £60,000. At a 75% mortgage, let's say the mortgage rate is like 6%. At 75% mortgage, we're looking at 150,000. You can pull out all your money plus an extra 150,000, and you're still making money as a service accommodation. As an HMO, to do, pull out all your money at 70%, you'd make an extra 60,000, but you'd only be making £345 a year. However, I think that'd be worth it to pull out £60,000, tax-free. In fact, lose money. It might even be worth losing the £5,000 because you on 75% refinance, because you'd be able to pull out an extra 150. So these are the decisions you would want to make, but there's loads of money if you want to refinance as a HMO or service accommodation. So there we go, we've looked at the deal. It's a fantastic investment if you use it as a flip. If you want to do it as if you want to keep hold of the property and pull out your money, then a combination of an HMO and a service accommodation I think would work best. 90 days during the summer for the service accommodation, the rest of the month as an HMO, maybe get a social housing provider in that. So absolutely fantastic opportunity, amazing find whoever decided to buy this. If you are interested in finding opportunities like this, now I can't guarantee 40% return on investment. Anything above 20% is kind of the Goldilocks zone. So if you're looking for deals similar to that to make great money, find great opportunities, I spend every day looking for these kind of opportunities, and I work with a team of sourcers that are doing exactly the same thing. I work on a bespoke basis only. So if you're an investor and you know exactly what you're looking for, sign up to my website, book a free 30-minute call, tell me what you're looking for, and we will work with you to find your perfect opportunity. Thank you for watching. If you want to see more of these videos, then hit subscribe, and I look forward to seeing you in the next one.